Every year, banks make hundreds of billions of dollars off a product that feels harmless, almost invisible, because you probably carry it in your wallet right now. It's slim, shiny, and promises convenience at every checkout counter. Your credit card. On the surface, credit cards look like modern tools of freedom. Swipe now, pay later, collect some rewards, and maybe even build credit history along the way. But behind the curtain, this is one of the most profitable traps ever designed in modern finance. When most people think of banks, they picture mortgages, car loans, investment banking, or corporate finance. But the truth is, credit cards are the silent engine of consumer banking profits. The margins are massive, the customers are hooked for decades, and the model is brilliantly engineered to look like it's helping you, when in reality, it's quietly draining your future wealth. Let's start at the surface level, the swipe. Every time you swipe your card for a purchase, two transactions happen. You get your product, whether it's a coffee, a flight, or an online subscription, and the bank gets paid too. This happens because of interchange fees. That's the small percentage, usually 1 to 3% of the purchase price, that goes to the bank or credit card company. It sounds tiny, right? Just pennies on the dollar. But multiply that by billions of transactions a day across the globe, and suddenly we're talking about tens of billions of dollars every single year in profit, all before a single cent of interest is charged. But banks don't stop there, because the real treasure is not in swipes, it's in debt. The moment you don't pay your balance in full, you enter the world of credit card interest. And credit card interest isn't like normal loans. It's not 5 or 6% like a car loan. It's not 7% like a mortgage. It's often 20, 25, even 30% APR. That's not a mistake. It's by design. Imagine borrowing $5,000 at 20% APR and only paying the minimum payment each month. It feels manageable at first. The bill looks small, and the credit card company reassures you that you're on track. But hidden in that minimum is a trap. At that rate, it could take you 20 years to pay off that $5,000. And by the end, you might have given the bank $10,000 or more in pure interest. That's not just expensive, that's financial quicksand. So why don't people just pay their balances in full? The answer lies in psychology. Credit card companies have spent decades perfecting the art of behavioral manipulation. They know how humans think. They know we're more likely to focus on the minimum due rather than the full balance. They know rewards programs like cashback and points trick our brains into believing we're winning while spending. They know that if they design their apps with clean dashboards and payment due reminders that don't feel scary, people will swipe again tomorrow. It's the same principle casinos use. Give the illusion of control. Let people feel like they're in charge, even though the system is rigged for the house to always win. In fact, some of the biggest credit card companies hire behavioral economists and data scientists whose sole job is to make swiping feel seamless, painless, and even fun. They study when you're most likely to overspend, how often you check your account, and even which words on a statement make you less likely to pay in full. Every part of the system is optimized for one outcome: keep you swiping, keep you carrying a balance, and keep you paying interest. And if interest wasn't enough, fees add another layer. Miss a payment by just one day? That's a $35 late fee. Go over your limit? Another fee. Travel abroad? Get hit with a foreign transaction fee. Take out a cash advance from your credit card? Say hello to fees, plus an even higher interest rate. In the US alone, consumers paid over $120 billion in interest and fees on credit cards in 2022. To give you perspective, that's more than the annual profits of Apple or Microsoft, an entire tech empire in fees, quietly collected by banks without most people even realizing it. From the bank's point of view, credit cards are the dream product. They don't require collateral like a house or a car. They're unsecured, which means if a customer defaults, the bank isn't stuck with an asset. Instead, they spread risk across millions of users and cover losses with sky-high interest rates. They're versatile. People use them for everything. Coffee in the morning, gas in the afternoon, dinner at night. They're sticky. Once you have a card, you're more likely to open another, transfer balances, or take on more debt, deepening the cycle. And they're profitable. Even when people manage to pay in full, banks still collect interchange fees and earn money from merchants. Today, Americans owe over $1.1 trillion in credit card debt, the highest figure in history. That's not just a statistic. That represents millions of families sacrificing vacations, delaying home ownership, or working longer hours just to service debt that keeps compounding. Every household carrying balances is effectively paying double or triple for everyday items. Once at the store, and again over the years through interest. For banks, it's a gold mine. For ordinary families, it's a weight that shapes their financial future. But here's the part most people don't see. The cycle is designed to look normal. Banks don't want you panicking. They want credit card debt to feel like just another bill. That's why minimum payments are framed as if you're making progress, when in reality, you're barely touching the principal. That's why reward programs make swiping addictive. That's why credit limits keep increasing, so you feel wealthier than you really are. The entire system depends on people thinking debt is manageable, even when it's quietly draining their lives. So how do you escape? First, never trust the minimum payment. That number is not designed to help you. It's designed to keep you in debt as long as possible. Always pay more, even if it's just $50 extra a month. Second, use the avalanche method. Target your highest interest card first, while paying at least the minimum on others. Once the most expensive debt is gone, move to the next. This strategy saves you the most money over time. Third, don't fall for lifestyle creep. Just because your limit goes up doesn't mean your income did. That extra room is bait. Fourth, use rewards only if you're debt-free. Points, miles, cashback, they're not gifts. They're bait to keep you swiping. The only way rewards make sense is if you never pay interest. If you're already deep in debt, consider a balance transfer with 0% APR for 12 to 18 months. But treat it like a lifeline, not free money. If you don't pay it off during the promo period, the interest will hit you even harder. And most importantly, change how you see credit cards. They are not free money. They are not an extension of your salary. They are loans, often the most expensive loans you'll ever take. When you understand that, you change your behavior. You stop seeing swipes as harmless and start seeing them as contracts with the bank. You stop falling for points and start asking, who's really paying for these rewards? And you stop accepting debt as normal and start realizing it's a tool banks used to control households for decades. Here's the truth. Banks will always design products to maximize profit. That's their job. But your job is to protect your money and your future. You don't have to reject credit cards completely. They can be useful for building credit, for convenience, for rewards, but only if you flip the script. Pay in full. Stay disciplined. And never forget, every time you swipe, someone else is making money off that decision. The question is, will it be you earning rewards without debt, or the bank earning billions off your interest? If this opened your eyes to how the credit card business really works, hit the like button so more people can escape the trap. And if you want more content that reveals the hidden side of money and finance in plain, relatable language, subscribe. Because the system is designed to keep you in the dark, but together, we can bring it into the light. Don't let the banks win.